But we'll talk about IT, the P mood, why suddenly there is a global interest in Indian IT companies and infra companies with Rahul Bhasin, managing partner with Baring Private Equity Investment. And Rahul, we know the fact that you would not like to talk about NIT and what Baring Asia has done. So I won't get into specifics here, but I'm very curious to talk about what is your take on the Indian IT industry per se, because there are a lot of promoter exits, there are a lot of promoter changes which have happened not in one but couple of Indian IT companies, especially in the mid-tier.
Look, I think if you think about it, we still have a huge talent pool. There's still a shortage of IT. IT worldwide is recreating every industry on planet Earth. There is demand, there is market relevance, and there is likely to be growth. Now, will the business models in the IT companies evolve and change? Of course they will. And there will be winners and losers. But I think what you're also observing in India is a generational change. I think that a lot of the entrepreneurs who started a while ago, I think are sort of going into retirement mode at some level. I mean, it's a treadmill that they've been on for decades, and I think that it's just a passing on of the baton. This is normal transition. I don't see anything peculiar or particular in terms of what we are seeing. This is just a transition. I think the other thing which is different about IT is that if you look at the types of entrepreneurs you have, they're typically the professionals, and most of them look at the baton being passed on professionally. It's their social status is not determined by their ownership or them working in A company or B company, as has been the case in what I call hereditary or businesses which have been passed down. So I think that there is less of a reluctance and there's much more of a practical approach to encashing their chips when they want to retire, I guess.
In today's time, when we are talking about AI, big data, digital adoption, reboot of the IT sector per se, where the Googles and the Facebooks of the world will be the dominant player in the data market, where does Indian IT company fit in? These are companies which largely benefited because of the arbitrage. Some of them have skilled, some of them have not skilled. But do you think that Indian IT sector, at least the few good ones, can continue to chug along a growth of 10, 12, 15% for 3, 4, 5, 7 years?
I absolutely believe that they can grow at those levels. I think, like I said, there will be winners and losers. And I think that if you've got a very large base of traditional kind of work, then the transition the impact of the transition is kind of slow, felt in a slightly slower manner. But if you look at most of our market leaders, whether it's Infosys, TCS, etc., I think they've adapted themselves and are responding to market evolution very quickly. And I'd just like to point out that this is not the first time you're seeing this disruptive kind of innovation and disruptive change in the IT industry. I think it's pretty much par for the course. I mean, you look at the last 20 or 30 years, paradigms have changed, the different software initiatives have changed. I think what is evolving very clearly is that the processing speeds have gotten to a level where you can deal with significantly more data in real time, and that allows for different learnings, etc., to be adapted into algorithms. And those algorithms are now called artificial intelligence. So it's not as if something has fundamentally changed. I think we've created new labels for something which has been an ongoing trend for a while. And I think that when you want to do that, then domain specificity and domain knowledge will definitely give you a sort of added advantage, and therefore you'll see smaller companies also having a sort of place in the sun in these circumstances, especially those who have specialized domain knowledge in different verticals. And I'm quite sort of sanguine about the prospects of the IT industry.
Rahul, hi, morning. How is it that you're reading into the market texture? You know, it's like one of the market stalwarts was saying when we were interviewing him that market has risen up. It's risen up too fast, too soon, but there's still a lot of unhappiness because it's only those 7-8 stocks which have done well. The rest of your portfolio is still bleeding.
I think the key is that if you look at why the markets run up suddenly, I mean, it's largely been because you've had a lot of foreign inflow, and that sudden foreign inflow has been dominated by ETF buying, and it's because that it's the ETF passive funds who have allocated capital into emerging markets, and since that's the driving force of the rise, which is why you see that it's been a fairly narrow set which has gone up at this moment. And if you look at where our Indian markets are trading at, I mean, they're almost at 24 times earnings. And if you look at that from a historical context, it is slightly on the expensive side. It is probably 2 sigma away from where the mean is typically. But I strongly believe when I look at capacity utilization data for broader industry at 78%, for cement at 80%, for certain sub-segments and certain geographies, that number is higher. I really think that we are on the verge of a capex cycle. Maybe that's 6 months away, maybe that's 9 months away, but I think it's inevitable. And I think that we will get into a new growth cycle. And I think it has very little to do with elections. So there is reason to believe that even though it's expensive, there is a fair degree of justification as to where the markets are.
Okay. So I'm just trying to get this right here. You sound a little circumspect about the market at 24 times. You think the best is already in the price? Or do you think the best is yet to come in the near term?
I think if you have a 3-year view, 5-year view, 10-year view, I think the best is yet to come. If you have a 1 month, 2 month, or going into election view, I think the best is in the price, because it's tough to see how anything can pan out in terms of event risk, which the market will look at favorably, which is not discounted already. So I think there is probably short-term risks in the market, but if you actually have an investment horizon, which typically asset managers like ourselves do, where we look at fairly long term, I think there is very little risk in the markets at this juncture, and I think it's an attractive proposition.
Well, hi there, good morning.
If one can identify companies which are gaining market share, you'll be okay.
Fair enough. Wanted to get in your take on earnings, because another veteran we spoke to said historically the earnings growth or the earnings trajectory hasn't really favored us. So going into the earnings season right now, are you going to roll back your earnings estimates again?
Did you ask me that question?
Yes.
Yes, very much. I mean, if you look at the last 5 or 6 years, magically at the beginning of the year, the street projects an earning growth of between 15 and 18%, and as the year draws to a close, that number is revised downwards. I think that we have to accept the fact that structural inflation has declined in our economy. So I think that the historical numbers we were used to in nominal terms may well be lower. But I also believe that the cost of capital should also decline correspondingly, and we haven't seen that happen yet. So I think that there is that kind of imbalance in the market currently. What you will see, and like I said, I mean, it's been a long time coming, and it's one of the reasons why it's been a long time coming, the earnings growth, is that effective capacity has been raised by most industry a lot by simple investing in productivity, IT. Now that IT gets expensed, so you don't see it in the investment line, but that has effectively raised capacity a lot, because if you look at it, I'm saying we are now at 78% capacity utilization, but we were around 70 even 6-7 years ago, and we've been growing at 7% a year for several years. the math doesn't add up. And the reason the math doesn't add up is because IT has effectively been enhancing the effective capacity of industry significantly. But I do believe that we are reaching a point now where you will see a capex cycle beginning to restart. Probably led by cement and steel, but it will soon cascade into other industries.
What are the chances, Rahul, that when earning recovery actually happens, asset prices don't go higher? Because the template that capex will pick up and the cyclicals will make a comeback, that has been in the works for last couple of quarters now, and most of the local money is positioned to that. I mean, they own corporate banks, they own names like L&T, couple of engineering names. So my only fear is that yes, recovery will happen. It could get delayed for another 6 months, who knows. But how much of that template is already been factored in?
Again, it really depends on your time horizon. If you're looking at 3-6 months, maybe your concern is very valid. But just look at the growth trajectory. We're still a $2,000 per capita income country. And if you look at a lot of the structural changes which have happened, which are actually depressing growth and depressing the earning capacity at this moment because of the process of that change, which has been hurtful in several ways, I think that that's actually going to lead us to a higher growth trajectory, and a sustainable one at that. Add that to a lower cost of capital, which is likely to prevail in the economy, and I think that there is tremendous upside in the capital markets. It's not, but if you're a trader who's looking at maybe a day or a month or 2 months, I think that your concerns are very valid.
In your last investments, where are you shopping or picking your spots in this market?
There are lots of niche businesses available, and there's a lot of disruption available. So it's a very large and a vibrant economy, and we have an entrepreneurial culture. So we find actually no shortage of opportunities. And that's been the case for a long, long time. It's just that I think that somehow, in some ways, rules of doing business and ease of doing business have improved. In some other ways, there's still a bottleneck. But the sense I have is that the bureaucracy, the government in most states are actively cognizant of this and seem to be actively working towards resolving it. So I actually remain quite optimistic.
All right. On that optimistic note then, Rahul, we'll let you go. Many thanks for joining in and telling us a little bit more about your outlook on earnings, the markets, as well as the IT space.